Fantastic. So today we're talking about syndication and crowdfunding. It's the brand new year. We're kicking everything off. I think everyone's brushing off the dust and looking for new deals. And so, whenever you're going out and you're looking at deals, you have to go and find a way to raise the capital for that deal, right? So that's what we're here to talk about today. How do you do that in a compliant manner? So, we're covering syndication and crowdfunding today, and I want to just very quickly define the terms that we're talking about. Syndication is very easy. All it means is just group investment. That's it, right? It's a group of passive investors that come together and pool their dollars. Now, crowdfunding, I would say, is syndication's 21st century cousin, right? So in lay terms, I would describe crowdfunding as just online syndication. So now we've got the internet. It's this wonderful thing. Now anyone can possibly participate in a deal, right? Okay, sorry. Did someone send a chat? I'm not sure. Anyways, so just for you, those of you who don't know, there are 4 types of crowdfunding, okay? We're only here to talk about, what I call investment crowdfunding. So for those of you who have heard of GoFundMe, right? Like, oh, maybe we have this Olympic athlete, help them get to the Olympics. You give them $5, and sorry, I'm just reading the chats. So if you go to GoFundMe and maybe you give someone $5, what you get in return is good, happy feelings, okay? You don't really get a return on investment. That's about it. Now, when you think about something like Kickstarter or Indiegogo, that's what we call rewards-based crowdfunding. So that is, I don't know, like maybe I'm inventing a new version of the cell phone. Hey, before we actually go to market, can you help sponsor to maybe fund the prototype or our first batch or our first production? So maybe if you give me $5, I give you back a shout out on Twitter, or I give you the first prototype version of, this cell phone. So you're getting a reward or you're getting a perk, right? But you're still not getting a return on investment. And that's really important. What we're really here to talk about today is investment crowdfunding. So that's where you are getting a return on investment. And so there's 2 types there. There's equity crowdfunding and debt crowdfunding. And they are basically exactly what they sound like, right? So when you're doing equity crowdfunding, you are giving some money and you're getting some sort of equity in return. When you're doing debt crowdfunding, it's much more often something like, there's an interest rate. Maybe it's 10%, maybe it's 12%, but it's not actually an equity stake in something. And there's all different types of investment crowdfunding. You can do it for regular businesses. You can do it for restaurants, and you can do it for real estate. So today we're primarily concentrating on real estate. So you might be thinking, why is a securities attorney talking to me and, making a kind of a disgruntled face? And trust me, I know that talking to attorneys is not the funnest thing in the world. So I'm going to try to not be boring about this presentation. But I do want to tell you a very quick story about a bunch of orange groves and a guy named Howey. So once upon a time, a couple of decades ago, there was an orange grove farmer in Florida who, was doing okay. He was doing well. But one day he decided to be very creative because he saw all these tourists coming to Florida, right? And he thought, hey, maybe I should sell them the land and I can rent it back and farm on it. And, I'll promise them the rents as, some sort of return on their investment for owning the land. So he went out to like very touristy areas in Florida, and he, flyered a bunch of places, and he was basically targeting tourists who knew nothing about agriculture. And in doing this, the SEC found out they were not extraordinarily happy. And so what we have from that whole story, and it's a true story, is what we call the Howey Test. And the Howey Test is the basic test that the SEC looks at in determining whether or not something is a security. I promise we'll get to the point in a second, right? So if something is a security, then you have to follow securities laws. If it's not a security, then you don't have to, right? In the real estate investment arena, whether you're doing syndication or investment crowdfunding, most often it is a security. So what is a security? It's a 4-factor test. The first factor is it's an investment of money. So the way that this prong of the test is usually interpreted is that money has a very broad definition. It's not just US dollars or Japanese yen, right? It can be Bitcoin or cryptocurrency. It could be, your services that you contribute to, whatever endeavor you're taking part in. The second part of the test is that there has to be an expectation of profits, right? So, let's go back to the Kickstarter example. If I'm going to get back a prototype phone, or if I'm going to get a shout out on Twitter, is that an expectation of profits? No, not really, right? Profits is really like, you might have losses, but you might have gains. But if you're getting like a physical object, that's not really an expectation of profits. And then there has to be a common enterprise. In a common enterprise, and I'm going to simplify the test for you guys, right? But a common enterprise really means like it's a group of people who are all involved in the same thing. So if one of you is involved in investing in 123 Main Street and someone else is investing in 124 Main Street, they're different properties. Maybe, I don't know, 124 Main Street burns down, right? And so all the investors in there lose money. Or maybe they add a swimming pool and an additional room, and the value in the investment increases, right? So everyone invested in 124 Main Street, like they all rise and fall at the same time in terms of what happens with investment. So they're kind of all invested in the same thing, basically. And the last prong, and I think often the most important, right, is whether or not it depends solely on the efforts of another. So let's talk about this real quick. In the real estate space, I often distinguish between passive and active investors. So active investors are what you would frequently consider as sponsors in the deal, right? They are the people who are going out, they're finding the property that they're interested in investing in, they're flying there and due diligencing it and, going around and raising the capital. And then once they've actually close the deal and acquire it, they are getting either renting it out or they're getting a property manager. They are still involved in the deal because maybe they're doing value add of some sort. Maybe they're repurposing the property. So they're involved in the strategy. They're still doing investor relations, handling distributions. And when they say, hey, maybe now is a good time for an exit, they're selling it, right? And then taking those distributions, giving them to an investor. But the investor is not the sponsor. The investor sits there, they tend to be passive, and they're happy because they don't have to do too much work, and they get some sort of return on investment. Now, what is not a sponsor, right? So a sponsor is not, for example, like I once had someone ask me, oh, could I count my investor as an active person on the project if, I throw a Thursday night, wine and cheese meeting, and, they come there and we do something like, oh, decide on the color of the paint of the house. That's not really good enough, right? Uh, you really have to look at, at the end of the day, is this person actively involved in the deal? If they're not actively involved in the deal and they are investing money and it's based on the efforts of the sponsor, not themselves, then that's really when you start getting into the territory of it being considered a security. All right. I know this screen is very intimidating, but it's actually pretty simple, and I'm going to walk you guys through it. There are a number of different federal laws that people can raise money under. And actually today, it is much easier to raise money than it's pretty much ever been, right? Because the Jobs Act of 2012 came out with 3 different crowdfunding exemptions. And those crowdfunding exemptions basically give you a lot more freedom in crowdfunding. So the, hold on for one second. The first exemption is actually a very traditional one. It's one that 99% of, what do you call it? It's what 99% of what people tend to use when they're going out and doing a private raise. When I say a private raise, I mean they're not public, right? They're not doing, expensive multi-million-dollar shelf registration with the SEC. They're not IPOing on the New York Stock Exchange, something like that. They're doing it privately, maybe with friends and families, maybe with groups and networks of investors, which is what syndicators tend to be doing, right? So this first rule is called Rule 506B of Regulation D, and basically it says this: you can raise as much money as you want from as many people as you want. We're not going to limit you in that regard, right? But you can only have up to 35 non-accredited investors and an unlimited amount of accredited investors, and we're not going to let you advertise this deal publicly. So you cannot talk about this on Twitter. You can't talk about it on your LinkedIn or your, crazy social media. You can't go to a meetup full of people that you've never met before and, grab the microphone and tell everyone, hey, I'm raising $5 million for my public storage deal. Let me know if you want to invest. You can't do any of that, right? It's really got to be limited to your pre-existing network. Now, that's the rule that's been around for several decades. In 2013, a new rule came out that does allow for advertising, okay? And that one is called Rule 56C as in cat, under Regulation D. So now we're suddenly allowed to advertise. We can talk about our raise on LinkedIn, Twitter, Bigger Pockets, to your heart's delight. However, we can still raise as much as we want. We can, have as many investors as we want, but we can only accept accredited investors. We can no longer have those 35 non-accredited investors, right? And on top of that, now we actually have what the SEC arbitrarily defines as rich is someone who, for the past 2 calendar years, has made a salary of $200,000 or more if they file taxes singly, or $300,000 or more if they file taxes jointly, or they have to have a net worth in excess of $1 million, excluding their primary residence. So basically a rich person, right? Everyone who doesn't meet that criteria, we consider a non-accredited investor. So Rule 56C, you can go out and publicly advertise, but for the people that you solicit through this process, they're going to have to basically be rich people, and you're going to have to take reasonable steps to prove that they're rich. Reason being, the SEC doesn't want you to go out and advertise your deal and attract grandma and her last Social Security paycheck, right? Grandma might not know what she's investing in. She doesn't have money to lose. Now, the next two regulations I'm going to talk about, I think are very particular because I think it does depend on where you are in your experience in the real estate space. And today I'm speaking to real estate specifically. You can obviously use these regulations to, fund your business or whatever. And you would use these regulations at different life cycles within the business. But, I'm just going to touch on real estate for today. So the first one I'm going to mention is regulation crowdfunding, or on the chart, it's called Reg CF, right? A lot of you guys might have heard in the news about equity crowdfunding being legal and stuff like that. So this is actually one of the newest rules. It basically says, hey, we're going to let people go out and advertise, and we're going to let them raise from non-accredited investors. So they can raise from, Joe Schmo. It doesn't have to be like someone who's super rich. However, we're going to limit their raise amount to about $1 million and change every 12 months. And there's only certain ways that they can do this. They have to be either on a registered funding portal, or they have to do it through a licensed broker-dealer. Both of these types of entities are FINRA regulated entities. And so it's very high, it's a regulated space, right? I would say that, relative to other types of ways that you want to raise money, it's still not that much paperwork, but it's still paperwork. And certainly it's more paperwork than the other two, rules we talked about, Rule 56C and Rule 56B. So at least in the real estate space, regulation crowdfunding is usable, but it's usually not quite as usable because, a lot of folks, especially to the extent that they are more sophisticated, they do a lot more deal flow, they're more active investors. $1 million in 1 year does not do a whole lot for them, right? So typically you don't see people in the commercial real estate sector using regulation crowdfunding. To the extent you do see people using this rule, it's more often that they're doing something in the residential space, right? Because then you can flip a couple properties a year or something like that. And residential real estate, by and large, tends to be less expensive than commercial real estate, although that also depends on where you live. And then what I would say is the opposite of regulation crowdfunding is what we call regulation A+, right? That's the third one that you see in the chart. Regulation A+, I would say, is for very experienced, very sophisticated people, because now suddenly you are allowed to raise up to $50 million every 12 months. You can do it through a fund, for example. And you can go out, you can advertise, you can generally solicit, and you can raise from non-accredited investors. But what I typically say for, all the rules that we've discussed is, what the SEC taketh, the SEC what the SEC giveth, the SEC taketh away. And what that really means is the more freedoms that the SEC gives you in going out and raising money, the more they're going to ask for in return. So regulation A+ obviously sounds the most exciting so far. We can raise up to 50 million. These people that we get the money from don't even have to be rich, but the SEC is going to ask for something in return, right? And so regulation A+ as compared to all the other ones I've described is probably the most demanding in terms of paperwork. You do have to actually go get approval from the SEC. We call this qualification. You have to write this big long document full of disclosures. You do have to get an audit. There are ongoing reporting requirements. So it's not the simplest thing in the world. It is a 4 to 6 month process, right? Whereas the other ones tend to be a lot cheaper, a lot faster. They, don't necessarily require, a full-on audit. And then, every state has their own securities regulator. And so to the extent that you are happy with just accepting investors from one state, each state has their own intrastate exemptions, but I'm not going to go over them today because there's 50 different states and they all have different rules. So I also wanted to tell you guys a little bit about what I do and how we're kind of innovating in the space, right? So, real estate crowdfunding, real estate syndication, all of it is obviously part of the capital raising process. And for that, very often you will need an attorney, specifically an attorney who specializes in securities law. However, as an attorney, I often find that the practice of law is a little bit outdated. I remember in 2016, I got a call from a friend that I had actually met at a Bigger Pockets event, and he said, "Hey, Amy, I want to do a syndication. I want to syndicate $300,000." And I told him, "Hey, so, I can tell you what the process is, and then I'll tell you the price tag. And I promise that you will not go out and, use me or do a syndication because the transactional cost just isn't worth it." Right. So I told him the price, and, he scurried away and, did something else with the deal instead. But the truth is, as complex as this documentation can be, I've always believed that there are ways to automate it, there are ways to standardize it. And so, I basically left my law firm at the beginning of last year and started a legal technology company. It's called Bootstrap Legal. And basically, we use some simple AI and automation to get at least the first draft of real estate syndication documents done. And in that process, I believe attorneys, save at least 10 to 15 hours of time. If you bill that out at a couple $100 an hour, you're basically, saving a significant amount. Plus the fact that we are, I think, faster, right? Usually as an attorney, I would have to sit down and do these first drafts manually. Now, not so much anymore. So I'll take you through our process. So basically, folks would first come to the website, schedule a consultation with me just to talk about the deal and see if they're even a good fit for the product. To the extent that they are, they would digitally sign an engagement letter. We don't do documents here where you print it out, you sign it, you scan it. I feel like it's a huge waste of time. We are integrated with Stripe, so we do accept credit cards because I know people don't really like running to the bank and sending a wire. And once that process is done, basically, I send the client a questionnaire, and it's kind of like TurboTax, right? They, actually, I should show this to you. So they basically go onto the system. This is the questionnaire. They fill out their information. They click register, and it takes them through a bunch of different questions. And based on what you answer before, the questions might change, right? So it'll ask you basic questions, and then, as the survey evolves, it'll ask you more specific questions. But, I've used TurboTax before, and there are always times when you kind of second guess, oh my gosh, I don't know if I'm answering this correctly. So basically, once you get to the last page, you basically click submit, and you schedule a consultation with an attorney in our network. It might be me, it might be somebody else. And then they take some time to walk you through the questionnaire, answer your questions, and make sure that you actually answered everything correctly, and it's like the best strategy for you based on your goals, right? Now, once you click submit, basically it goes through our software on the back end, and basically in about 48 to 72 hours, the first draft is completed. The documents are generated, and an attorney goes in and reviews them. So then they appear in your inbox. What is included is usually a private placement memorandum. Now, that's something that basically is a large disclosure document that talks about all the risk factors of the investment. It might have, multiple operating agreements depending on your structure, and a subscription agreement. The primary difference between us and I would say law firms is, I'm not trying to replace attorneys, but I am trying to make the process a lot more user-friendly, approachable and affordable and fast, right? Like every single, I would say almost every single deal I've ever done, the minute they get it under contract, suddenly they're on a crazy timeline, and they've got to get their legal documents. Time is money. If you can have an extra couple days to raise, that's really valuable. We're also affordable. We basically do flat fees, and we have a hybrid model. You're basically paying for the software and attorney services. And it's friendly, right? Like all of this is meant to be user-friendly, because there's a lot of stuff that I felt like people just shouldn't have to put up with in the legal process. But the most important thing is that this is still very high quality. And I say that as an attorney myself. These are documents that I would have drafted as an attorney. And in the end, everything is still attorney reviewed and attorney edited, right? And that's pretty much it. I tried to leave a lot of time for questions, because, I don't know if people have questions specifically more on syndication or crowdfunding, but yeah, do we have any questions?
That was a great overview. Yeah, so we're going to do questions by chat. So just type in your questions, and Amy will be kind enough to hopefully answer. I guess just to kind of kick it off, what kind of advice would you give to somebody that is maybe just an investor, maybe not planning to do their own syndication, but just wants to be aware of the legal aspects? What advice would you give someone that's just looking to invest in one?
Yeah, sure. Well, obviously I would always say investors should do their due diligence, right? I know people don't do this often, although I have seen people do in the past, but they should go through at least the PPM, and there are parts of the PPM that matter, right? Because it talks about deal structure, it talks about your rights as an investor, and it talks about, at the end of the day, what you're going to get as an investor. And you want to make sure that you understand the terms and that you're crystal clear on it, because there's nothing worse for an investor than getting shafted on the back end. There's nothing worse for a sponsor than to have an investor invest under some misconception or preconception, and then, several years later have to disappoint them by clarifying on the back end, not the front end.
Are there any red flags in a legal document that investors should look out for?
Oh gosh. In terms of the passive investor, like I said, I would look at voting rights. I think one of the most important things in any real estate deal is the track record of the sponsor. So you want to make sure that they know what they're doing, right? And then to the extent that maybe the sponsor doesn't have a huge track record, or maybe this is a much more risky deal, maybe there's some sort of environmental issue, right? You want to make sure that you're getting risk-adjusted returns. So the riskier the deal, the more you should be getting. And, the less risky the deal, probably the smaller your returns. And it also depends on where in the capital stack you fall, right? Debt is different from equity. Equity usually ends up having a higher return because you're the last one to get paid. Whereas for debt, maybe if you are part of the first lien or the second lien, it means you get paid back first before equity investors get paid back. So I see a question. So Doug asks, how early in the real estate transactions should the SEC paperwork be initiated? So that is a really good question. So basically, it depends on what you're doing, right? Let's take two different scenarios. One is if you're doing a single asset syndication, that means you've already identified a specific property that you want to raise money for. The second is a blind pool, where you're basically starting a fund. Maybe you don't have the specific properties yet. You're just trying to raise money. And once you've raised it, then you're going to deploy. Sorry, that is my dog. Can you, sorry, giving the husband the evil glare right now. So let's talk about single asset syndication. What I would say is, the moment you want to engage the attorney is going to be the moment that you get the property under contract, right? But you want to start the conversation before that, because there are going to be, I find, especially legal structuring questions. There's going to be questions around like, well, am I raising equity or debt? Am I doing a 5.6B or 5.6C? Like, what's my regulatory strategy? How many LLCs do I want? How is the manager structured, right? And so, and you're probably going to want to form a manager or form some entities. And once you have the deal under contract, everything happens really quickly. So in order to kind of prepare for that, I would say, at least 1 to 2 weeks ahead of time, you're going to want to call your attorney. You are going to want to say, hey, I have a deal coming up. It's in this state. I'm raising this amount of money. These are my goals. You might want to do a preliminary walkthrough of what the deal might look like, right? And sorry, my dog is really hyper right now. So you're going to want to do a kind of a preliminary deal structuring consultation with the attorney, right? Ask any questions of the attorney prior to getting it under contract. And so once you've established that relationship, get those initial questions answered, and you get the property under contract, that's when, the ticker starts. What you want to have ready for the attorney once you engage them is you want to have your pitch deck or your investment summary. This is usually like a 10, 20 page PDF document. It's got like your biography. It's got details about the property, financial projections, what investors are getting, right? You want to at least have a draft of that. And to the extent that your attorney is going to need to form new entities for you, just be ready in terms of, having a name so that they can get that process started as soon as possible. Now, the process for a fund, the blind pool fund that we talked about earlier, is a little bit different, right? For that, you don't have something under contract. So it's really based much more on your own schedule. So basically, when you are about to go ahead and, say, hey, I want to get started raising capital, then that's the time that you would go ahead, start calling the attorney, talking to them about how it might look. And, I find that with people doing blind pools, that the time period between when they first contact me to the time they actually pull the trigger tends to be a lot more, because there's no fire under their butt, right? It's really like when they get their stuff together. So for that, there really is no set time about when you should talk to the SEC attorney, but I would definitely give them, for a traditional deal, I would probably give them a month to work with, because there will be some back and forth. I've, papered deals in as little as a week, but it still takes at least a week, because, you've got to get entity formation done. Do you have any other questions?
So I see 3 they're sort of posted to the entire group. The first one is, can you throw some light if cryptocurrency income is considered income or more like real estate or physical asset? And what kind of capital gains tax would apply?
Oh, okay. I see these questions now. Okay, so cryptocurrency.
I knew cryptocurrency.
It's the new hot topic, right?
It's digital beanie babies.
Yeah, I know. Okay, so and first of all, I'm gonna throw out a disclaimer that I'm a securities attorney. I am not a tax attorney. So I'm happy to talk to the securities aspects of, for example, ICOs. The tax stuff I can really only answer generally, right? But generally, just like anything else in life, if you have made money on it, it's going to get taxed, right? So I know the IRS released some tax guidance for cryptocurrencies recently. Is it considered more like real estate or physical asset? I don't know. I'd have to go back to the guidance and look at it. What kind of capital gains tax would apply? I know there's actually a lot of changes to this right now, partially because they also are the IRS is also taking a stance in which coin to coin or crypto to crypto transactions, to the extent there's a gain, that's also taxable. But I'm not a tax attorney, so I'm sorry, I don't feel comfortable answering these questions. If people want to email me afterwards, I'm happy to refer them to a tax attorney, or they can talk to their CPA about it. Your CPA should be able to handle these kinds of questions as well. What is the ballpark cost for legal services to syndicate a deal for both your service and a traditional service? So it depends, right? So I would say that for a smaller deal, and by smaller deal, I mean something in the 1 to 3 million range, you're going to look at, I've seen people charge anywhere between, I think the lowest I've ever seen was maybe like 6,000. Usually it's at least 10 to 15. On the higher end, if you go to like a fancier law firm or something like that, where you're paying for the chandelier, it can go as high as $35,000 or even more. So that's for a traditional law firm. For us, we do flat fees. So basically, for a raise of up to $3 million, it's a flat fee of $7,500. And then anything after $3 million, because we still do use attorneys and all the attorneys in our network are bound by specifically real estate syndication malpractice insurance, which is actually the second most expensive malpractice insurance out there, I'm told. They actually have to report every single raise that they help to represent, and so their insurance premium goes up. And so basically after $3 million, the cost goes up incrementally, but it is still a flat fee. Ethan had a question. I have done real estate investing for about 4 years, but Crowdfunding and syndication are new to me. Can you please provide an overview of crowdfunding, syndication, how to identify good partners, and how crowdfunding and syndication can help an investor scale their business? Sure. So in terms of life cycle, most people start off with syndication, right? Because they'll start off with a smaller family, a smaller property. They will go raise money from their friends and family, and then they slowly start building a network of investors that they more regularly go to for every single one of their deals. Crowdfunding, I think a lot of people have this misconception that, oh, like if I post it online, the money will come. Money, you know, except maybe in cryptocurrency, doesn't really just fall down from trees like that. There still is an art to crowdfunding online. And I think over the past couple years, we've seen the evolution of crowdfunding. It really isn't very much for beginners. It tends to be more so for people who have a track record, because the most important thing when you're raising capital at the end of the day is building trust with your investors, right? And when you're going and raising capital one-on-one, it's a lot easier to build that trust over coffee, over dinner, over whatever. When you are crowdfunding, you're putting your deal online and you're saying to people, hey, trust me, right? And how are they going to trust you? One of the most important things that they're going to look at is your track record, your background. How many deals like this have you done? Is this your first time doing this specific asset class? Is this the first time you've raised for a $20 million property as opposed to like a small fix and flip, right? Like those things matter, those things count. So crowdfunding, usually I more so recommend for those folks who have a bit more of a track record, at least have done 3 deals. I have a question. What is the price for bootstrap legal service for, say, raising 20 million through crowdfunding, percent and fix? So I'm happy to, talk to folks offline about what pricing is after the 3 million range. We don't take a percentage fee. Everything's flat fee. Doug has a question. Could syndication be used for development, beginning with purchase, infrastructure installation, and initial construction purposes? Yes. I've actually seen everything across the spectrum, right? I had a deal at the end of last year where they were a bunch of guys in Texas doing basically speculative raw land development. So they would basically buy raw land. They would plan to improve it a little bit, enough so that like a housing developer could come in and turn it to a bunch of residential properties, right? I've seen people do that with improved land. Very commonly, especially in the commercial space, a lot of smaller syndicators are doing this with multifamily properties. I've seen people do this with residential properties, right? On the residential multifamily side, usually it ends up being like some sort of value add project. So you're taking a class C to a class B, or a class B to a class C, right? So you're making something that might be normal, upgrading it with like marble countertops and raising the rents, right? That's how you're increasing the value. People have done this with public storage. I've seen people do things where, there was one client last year where it was actually going to be a 2-phase thing, mostly because there was environmental cleanup that had to be done. So very risky investors came in first. They invested for the environmental cleanup part, and then they did a second round where, once the environmental cleanup was, all stable and underway, then they could actually go and build the property. And so, the second round of investors got obviously less returns because they came in later when the deal was a lot less risky. What other questions do you guys have? These are good questions, by the way. Okay. Raising funds for an ICO. An ICO, for those of you who aren't following the cryptocurrency or the crypto blockchain space, an ICO is an initial coin offering. It's also called a token sale. I think I just saw one article yesterday. Someone is cleverly trying to rename it like the Tau or something like that, but it's all the same thing. So raising funds for an ICO will close friends and or crowdfunding. So basically, is it legal? Will the SEC treat it more as an IPO or differently like venture capital? Also considering ICO product, a digital currency, to the extent, it's exchanged internationally, how do SEC rules manage that? Okay, so that's a great question, because it applies to real estate as well, right? The SEC's jurisdiction is, the SEC only really cares about protecting US investors. The rest of the world, they're not there to protect Singaporean investors or Swiss investors. So to the extent someone is raising funds from US investors, that's where SEC rules come into play. If you are never taking a dollar or a cent from a US investor and you're purely raising it from foreign investors, then SEC laws don't come into play, but the laws of the country of wherever you're taking that investment money from do come into play, right? So if you're raising it from China, there are certain Chinese laws that you have to take into account. If you're raising it from someone in, I don't know, Brazil, you have to follow Brazilian laws, right? Now, is it legal? It can be legal if you do it in a compliant manner. Right now, the SEC has basically said over the past several months that they essentially don't really believe in the existence of utility tokens, even to the extent that a token has some sort of utility function or purpose. It may still be considered a security. What I usually tell people is, hey, to the extent that, it's not just, oh, I'm selling tokens, right? That's not the relevant question. The question is, am I really fundraising here? And am I promising people a return, a possible return on investment? And how am I going about doing this, right? Like, tokens aren't like Pebble watches. They're not like cell phones. Like, people don't go buy 10,000 cell phones and hope to exchange, resell them later for a higher fee. So it really does look a lot more like investment sometimes. It's not that a pure utility token isn't possible. It's just that, very few people are basically being greedy right now. I'm happy to talk more about ICOs. I'm on a lot of the Bitcoin and cryptocurrency type podcasts where I dive into the legal there a little bit more. So maybe that might be a better forum. But to the extent that you are interested in ICOing, I would also add or mention that Bootstrap Legal also does have a smart contract product. But you can, listen to the Bitcoin podcast for information about that. All right. What do you look for when a group of friends or family syndicate in buying a multifamily with one or two active investors? So it doesn't matter how many active investors you have, it matters how many passive investors you have, right? If you don't have any passive investors, or you only have one, then you're not doing a syndication. You might be doing what we call a JV, a joint venture deal, right? Now, to the extent that you have two or more, passive investors, that's really when you're doing a syndication. So in terms of what to look for, I'm not, maybe you want to clarify whether you're talking about in terms of the property or like, what do you mean in terms of what you're looking for? Next question from Daryl. How are typical real estate syndication crowdfunding profit distributions structured? Like, what are the waterfalls? Are there typical examples of this? Great question, right? Answer is it depends, but I'll tell you what I typically see and then what the variations are. Typically, to the extent this is an equity deal, there's usually a split. I would say that it probably averages to a 70-30 split, right? 70% to investors, 30% to the sponsors. There is deviation, right? So sometimes I see 80-20 splits. I've seen as high as 90-10, but I've also seen as low as 50-50. It really depends on your track record, how sophisticated you are, and what your, how risky the deal is, and what the investor appetite is. And then there's a concept of preferred return. Preferred return basically means, okay, of the the first $100 that comes out of this deal, that's a profit. How is that distributed amongst everyone, right? And so a preferred return, let's say you have like a 8% preferred return. That means the first, 8% of profit goes straight to the investors. And then after that, the split might come into play, right? And there are a lot of different ways to structure this. I would say in terms of preferred return, I usually see like an 8 to 9% preferred return in multifamily. For new construction, the preferred return does tend to go up. But again, this is like, what do you think that your investors are still going to have an appetite for? Can syndication be only for residential land, or can it be for agricultural, forest, commercial land as well? Syndication can actually be anything. It doesn't even have to be real estate. It doesn't have to be land, right? If you guys are in the startup world, right? Angel List is basically, startup syndication. They're doing group investments for startups, right? So syndication can really be anything. It's just that today we're talking about syndication in the real estate context. Do we have any other questions? I know we're, about to run out of time. Good. So, if you guys have additional questions, I'm definitely happy to take them. You can email me. My email is Amy, that's Amy, AMY, at bootstraplegal.com. You can find me on Twitter and LinkedIn and, Facebook. To the extent you have a syndication deal coming up, I'm happy to do consultations. You can sign up for those on my website. To the extent that, it seems like some of you guys are interested in the crypto space, I've been talking a lot on that as well. But, please refer to the crypto type podcasts. And one last question from Ethan. Have you seen syndication used to quickly scale a furnished rental business? What kinds of profit splits and financial arrangements make sense in this space? So a furnished rental business. Yeah. So again, syndication you can use for anything, right? In terms of profit splits and how you actually structure the financing on that type of deal, it really depends on, are you asking for debt? Are you asking for equity? Definitely happy to talk to you about this in more detail, on an individual level.
Cool.
All right.
That's really helpful.